Welcome to the Rise Network podcast show, a podcast dedicated to help you reach your dream lifestyle through investing in real estate. We're going to be sitting down with new, intermediate, and experienced investors to talk all about real estate and how it has changed their lives. If you're looking to scale your portfolio or even just get into real estate investing, you're in the right place. Make sure to tune in.
What's going on, everyone? You're listening to a Rise Real Estate Investing podcast with your host. I don't know why I was about to say Austin Ye, but Mayutava and
this is the first time you said your last name, because usually you just say and Mayu.
Yeah, that's true. You brought this up before though when I did the intro, but
I don't like this. You're feeling a little bit of dominance now. That you're feeling overly confident and cocky.
what's that guy's name? Derry? No, not Derry. What's the Bigger Pockets guy's name? David Green.
Brandon Turner.
No,
that guy's gone.
I know. That's what I got David Green your ass and get that's off the podcast.
Oh, poor ass. So sad. You're bullying David Green. We'll never have him as a guest now. Anyways, you're with Austin Ye as well. What's going on, man? Now I get to ask what's going on.
Fuck, you're right, eh? Let's see what is going on. I've been talking to someone about potentially selling my 9-plex that I have up north. There's still significant gains left in the property. Like I literally have not gone up since I bought the property. We just done everything remote. So I've never done cash for keys with these tenants. And I know 3 of them would probably take a pretty moderate cash for key attempt. So I'm trying to see if either I go up there, negotiate the vacancy and then sell it, or if someone will just make my life easy and save me a 12-hour trip, then I'd rather just do it for a slightly lower price. But I'm talking to someone about potentially selling that and then using those proceeds to pay off a good chunk of our primary residence mortgage and then do the Smith maneuver and redirect those funds into something else. Other than that, there hasn't been too much on the real estate front that I've been working on. I'm trying to decide what's next. Like, what am I looking for? What am I trying to buy? Getting tired of losing out on some of these development-ish plays. And there's some lower hanging fruit in the commercial space, it seems, right now. You and I have always
Sorry, commercial as in commercial residential.
Yeah, commercial.
Resident. Okay, yeah.
I'm not trying to get into industrial or retail or anything like that. But you and I have always had the stance of we buy a property that we could just close on our own. And then if partners want to follow along for the ride, they can. But if they don't, we're perfectly fine, right? At least that's been my personal approach to this. And I think that's the position I want to be in, which is where selling that 9-plex would allow me to, close a $2 to $3 million-ish price point without worrying much if partners come along. And if they do come along, I can just close more. But if they don't, then it's not the end of the world, right? So that's what I've been kind of strategizing a little bit. I've talked to some people about Edmonton, different stances, different opinions and strategies, right? You and I have talked about Daniel Foch, I think, on Andrew Hines' podcast, just whether or not, I think that was where he said he talked about it, right? About how the MLI Select doesn't really allow for a lift in the value of the properties. And it's more of just a creative financing approach, right? So all good points, and I'm just kind of stuck in this little shithole where I'm trying to decide what is the next strategy, what do I do? But that kind of depressing conversation. But I think a lot of people go through the same points as well. But what have you been up to?
No, I think that's a good approach. What's holding you back from making moves is your primary, right? The variable, it's on variable, so that's going up, and you bought it not too long ago. So if you can pay down a decent chunk, then it opens your sort of avenues to different strategies, and you can feel less stressed. Because I know that's a source of stress for everyone. If you're not house hacking and your mortgage is massive, dude, you got to put food on the table first.
It's more about the Smith maneuver for me on the primary residence. The mortgage payment itself, I think we're okay with. I'm not struggling to make the payment or anything like that. But so I have a $700K.
All right, I get it. You're not broke. You just got to clear that shit up. All right.
My wife pays that shit, bro. So it's not an expense for me. But I realized at 7% or 6% or something like that, and it's a $700K mortgage. So that's a $42,000 a year interest expense that is not a tax deduction, which fucking
that's true.
Nuts, right?
Yeah.
I can Smith maneuver this shit, make at least half or 2/3 of it into a tax deduction. That's a sizable tax deduction, right? So I was talking to my dad about this on the way in, just trying to figure out what the tax consequence would be of the sell versus being able to save $30,000 a year as a tax deduction, right? So it's more on that side because the 9-plex is not I thought I would ever sell. I was gonna keep it for whatever amount of years and very small mortgage paid off and stuff like that, right? But just realizing the value of doing the Smith maneuver right now, and then still reinvesting it, but just increasing my tax deductions, that's really what's driving it. So it's a little complex, but so we'll see what happens.
No, that makes a lot of sense. I guess like the main thing is just making sure that you're able to get the return higher than the HELOC rate, because that's like 7% now, something like that. Anyways, I'm tired of hearing what's going on with you. I gotta, otherwise we'll make this preamble 20 minutes. On my end of things, not much. So let's jump straight into the pot.
You're just making memes on Instagram, eh?
Yeah, dude. Like it's I see a lot of people are doing memes right now, but it's such easy content. Like literally, my admin will send me a couple of things. I'm like, here are some topics, and then you have 10 pieces of content in 20 minutes, and that's really about it. So going a little bit harder on social media again with the mortgage agent thing, planning that out as well. Looking at probably launching sometime in February, but we'll see. Also, I guess I should mention this now. We're doing live Q&As, Ask Me Anythings on the Rise Facebook group. And this month we have Kellen, a multifamily expert. It's going to be Ask Me Anything on multifamily. Next month, we're going to be having Andrew Trebetta, who has been on this podcast before, and Ask Me Anything on the paralegal tenant side. It's more so a lot of business dev for me so far this week. That's a good way to put it, is business development. In terms of next moves on acquisition, honestly, not exactly sure what it's going to be just yet. Like, my mind changes from one thing to another pretty frequently. So I think I need to just buckle down and think through what my goals are in terms of like lifestyle and what is going to get me there. And just to that point you were saying about the podcast on Andrew Hines and Daniel Foch, I don't want to mince words or put anything in their mouth that they did or didn't say. So make sure to listen to that podcast, guys, for yourself. But it was something along the lines of, so you could over leverage on CMHC, because like an appraisal value doesn't necessarily mean what you throw it on the market and sell it for, right? And sometimes these things may appraise much higher than what they would sell for on the free market, and then you lever up on top of that well above 80% loan to value, right? Although the amortization's longer. So is that really a sustainable strategy? Could be, maybe not, but to each their own, right? You got to just make sure that the strategy makes sense for you. Lastly, I think we should mention property taxes. I know that was a hot topic, dude. Where were they proposing that property taxes increase?
Well, dude, you're in Toronto, eh? You're gonna feel this shit. You're gonna feel
but honestly, it's not. I think people are over exaggerating how much. Like, dude, like your property tax is 2 to 3 G's. That's a whole ton of money spread out in the year.
True.
That's an extra. Like, tell me someone can't cut down Uber Eats, just like one Uber Eats meal a month, and boom, you have enough.
I think it's a principle of it. If you start with a 10% increase this year, what is next year? What is the year after that? Versus, what was the guy's name? Tory? I can't remember. John Tory?
Yeah, John Tory.
John Tory, while he was in office, his entire thing was he's going to... like
husband of the year?
If that's what you're trying to be, then, you know...
No. I might have to edit that out. No, but go on.
His entire campaign was he's going to keep property taxes low because there's a significant population in Toronto, I think, that's still occupying these detached homes that are senior residents, right? So, like, while us, like, our income will go up, and for us, it's like, okay, $400 for a given year, not the end of the world. A lot of people today, like, they would never be able to buy into the houses that they have today if the property tax was actually at a good mill rate of like 1% or something like that, based on like assessed values and stuff like that. So they're the guys that are going to feel it the most. And then you've got, like, what does that mean for, like, the sales and stuff like that, that people that, like, a 10% increase in the property tax per year is $400. But so even if it's 40, 50 in 1 or 2 or 3 years, if they keep it up, right, what does that mean? It was interesting. I thought it was because of a reduction in the land transfer taxes. And then someone else had mentioned development charges. But Pri, who we've also had on the podcast here before, messaged me saying that the development charges actually go into a separate account for, like, capital improvement. So it can't directly be related to, like, the operating budget. So I don't know. I don't know what kind of shitstorm is brewing up in Toronto, but I'm sure it's going to hit multiple cities. Like, it's just going to get progressively worse, I think.
So our mayor actually had an announcement yesterday. At least she's being transparent. She said that we're at a 1.8 billion, like when she inherited a financial mess, her words, at the city, which includes a $1.8 billion budget shortfall. So she at least is trying to make a dent, right? Like, there's only a couple of things I bet that she's able to do. You can only cut so much. She needs to increase revenue. And maybe it's an unpopular opinion, I'm of the side that it's fine to increase property taxes, because Crimea River, a lot of people have seen a ton of growth in the Toronto real estate market, and the property taxes didn't necessarily keep up with that. I mean, you're getting growth 10% year over year, above and beyond that. And you know, it's a reasonable ask, right? Especially if the city is in a fucking nearly $2 billion budget shortfall. I don't know, it's just me, but I agree. Like if they're continuing to increase at 10% every single year, that might be a little bit worrisome. But that being said, I mean, we're still very low relative to, I think it is, are we the lowest relative to our house price? It might be.
Yeah, probably, but especially in Ontario. So what's your thought on rental licensing? Because Brampton brought that out as well. And I'm sure it's just going to become an increasingly more predominant thing. Like Windsor brought it out a couple of years ago.
Windsor, yeah.
Hamilton also.
I don't like it. I think that's going to take housing supply off of the market. It's going to incentivize people to sell their properties. I mean, because you're already cash flow negative, and now there's way too much intervention in the free market. I like, we're already seeing it in Windsor right now. The student rental market. Go on House Sigma, dude. Everyone is trying to offload it, right? And if you're going to be closing down, I know, I get the point of it as well. You don't want illegal units. But if you're closing that down, you're going to put more upward fucking pressure on the rental price.
I think it's going to be the owner-occupied rentals that essentially disappear from the market, right? Like if you or I have like 4 units and it's purpose-built for a rental, we're not going to all of a sudden be like, hey, we're just going to keep this property vacant, right? But if you make it more difficult for people to rent out their existing basements while they live upstairs, like adding an additional layer of like bureaucracy to go through, then it's a pain in the ass. I don't
know what they're trying to accomplish. Are they trying to add more supply or take more supply? Because this is taking more supply off the market.
They're trying to improve the quality of the supply, which
means you're taking more rental supply as well.
Yeah, I don't know if that's a focus right now, in my opinion, but whatever, it is what it is. What's the end solution here? And it comes down to like a free market theory. Like I think there's a couple of studies out there that just basically supports that if you just let the market dictate the demand, and the forces will just balance itself out, right? Kind of like in the US where there's a little bit more of like an oversupply. Apparently that's at least the conversation that I got. So I don't know, that might be the solution, but everyone that is upset about it, I think just sitting at home and just being quiet about it doesn't work. Like you got to be loud about it. That's my stance. So with that being said, and on that topic, our guest today is Jack Bernstein. Jack is a very impressive individual. He's got a portfolio of real estate assets over $10 million, but really what makes him unique is he's a realtor that focuses on multifamily apartment buildings, both smaller stuff, 3 to 4 units and above as well. And he does the larger apartment buildings as well in partnership with the Peak Multifamily guys. But really what made this episode unique is we kind of talked a lot about the alternative investments he's made. And that's been really inspiring for me, at least personally, right? Like I've always found a lot of the random investments that Jack has going on super interesting. And it's kind of like unique businesses that you or I would never really think about, right? So if you guys are interested in that space, so it all goes hand in hand, just talking about growing up, scaling your real estate portfolio, and then kind of moving into alternative investments and more active business income streams as well. So hope you guys enjoy the episode. As always, if you do enjoy the episode, share it with a friend, drop a 5-star review for us on Spotify. I'm pretty sure we failed our goal last year, but let's work towards hitting it this year.
Just a heads up before we get started, this podcast is all about providing you information, not financial or legal advice. So if you need the real deal for your situation, hit up a professional. We can't promise you our information is always up to date or accurate, and we're not responsible for any investment decisions you make based on it. Markets change, information change, you know the drill. Anyways, thank you for hanging out with us responsibly. Let's jump right on in. Hello, everyone. We are joined with our very special guest. He's here for another podcast episode doing a bunch of new things. Excited for this, Mr. Jack Bernstein. Jack, how's everything going, man?
Going good, guys. Going good. It's been a couple of years, I think, since the last time being on. So super excited to catch up and kind of dive into what I'm up to now.
Yeah, Jack, super interesting for myself, at least. Like every time I talk to you, you're up to something completely different. So for anyone that doesn't know the holistic picture of Jack, what is it that you do? What have you been up to? Even if you give everyone like a backstory and like quick backstory on how you got started, everyone can kind of go back and find your first episode for that. But since then to now, kind of what you've been up to as well.
Yeah, I'll just kind of take it back real quick on how I started. So was in software sales for a long time. And as a lot of people know, software sales is pretty good because it pays very well, but it's also a fairly flexible job. So while I was getting commissions and earned income and stuff like that, I started acquiring real estate over kind of 2018, 2019, 2020, 2021. And from 2018 onwards, I had basically a 5-year vision that I was going to buy a bunch of passive real estate and different passive income strategies, and then leave my corporate job and then pursue real estate, which was my passion full time. So I was lucky and fortunate enough to do that in 2021 and just celebrated my 2-year anniversary of, being in real estate full time. And it's kind of, sprung a bunch of different businesses that are mostly around the investment space in real estate, but also kind of drive my core passion in business, which is just acquiring more property for myself.
All right.
Awesome.
I feel like you kept that high level, but yeah, let's break that down a little bit. So you went self-employed 2021. And so what did that mean? Like when you obviously quit your job or you left your job in tech sales, what did you do? What did that look like? Where did you go from there?
Yeah, so I had this like really refined kind of 12-month plan in 2021 where I was going to leave in 2022. And I actually found out, I was working at TELUS at the time, that they were going to close my division down. So I kind of had first right of refusal from my boss that I could take the first round of layoffs, and they were going to give me basically 1 year's worth of severance, which was fantastic.
Wow.
Or I could stay on another 6 months, 8 months, whatever, and move into another division of the business or whatever. So the way I looked at it was, if I was planning on leaving, I may as well leave a little bit early and try to figure it out and get that payout now than maybe staying and go to another division and leave for free. But with that being said, I probably jumped into, the transition pretty quick without having maybe some of the foundations that I should have had. And it led me to basically build a bunch of different businesses really quickly and kind of put my back against the wall. But I was fortunate for the experience, right? Because the reality is, as most people know, you go into a different job, a different position, and you get comfortable. It takes like a year to kind of get up and running in the job. And then all of a sudden 2 or 3 years has gone by, right?
Right.
So I don't think there's ever a good time to actually do it. It's one of those things where you just kind of say, okay, I think I can take on the risk. I've got some fail safes in place, maybe a bit of money aside. Like, it's either now or never.
Right. Well, I almost want to dive into some of the things that you're up to today. So I guess when you were starting off, you were trying different businesses. I think we actually touched a little bit on that on the first episode. But since then, it seems like you refined what your focus is on the past year or so, which is crazy to think because everyone's been sort of taking their foot off the pedal, as you probably know, Jack, with everything going on in the real estate world. But just with our conversation before the podcast, you are in full force and you are crushing, it seems like, everything that you're doing. So would you let the audience know the different sort of avenues that you're doing, from investing, active income, so on and so forth?
Yeah, for sure. So I got about 5 or 6 kind of like active income businesses that I'm working on right now that all are somewhat vertically integrated. So like they all feed each other, kind of different leads and stuff like that. So the business that I used to help transition myself from my corporate job to doing real estate full time was my coaching business, and basically kind of having students that springboarded from a Toronto Life article that I did in, I think it was like 2020 or 2021, that, got a fair bit of people reaching out. So after having that coaching business for 2, 3, 4 years, students started having issues with different people that were helping them, professional services. And one of the common denominators was realtors and brokers. So I decided that I was going to add that to my skill set in my portfolio, not only for my own deals, but I figured that, with my own experience and some of the connections I have in the industry, I'd be able to add a lot of value and service to people. And it was easy to kind of grow that business because right away I had a bunch of people who wanted to work with me, which was my student base at first, but then it also springboarded pretty quickly into other people reaching out, and that business has been growing. So there's 2 businesses there. There's someone that I do some coaching with that I subcontract some students from. And then I have my main coaching business, and then the realtor business. And then I have my private lending arm. So I'm still always doing different loans and stuff like that. And then my 5th business that I kind of combine a bunch of other, what I call LP investments in. So limited partner, where I've gone into 5 or 6 different kind of business avenues and actually made passive investments in. So things like laundromats, restaurants, bars, stuff like that. And then the one that I'm the most excited about and, that I've been learning a lot from is working with Mark Baltazar and Mike Rockall, helping out, doing some stuff with their fund at Peak Multifamily, and then also learning a lot from Mike Rockall on the apartment building broker side.
Yeah, that was a lot. All right, let's I broke it down into 3 things I think we'll dig into, because obviously it's only like a 40-minute podcast. We can't go into everything here, but I'd love to learn a little bit about the realtor business, the limited partner business, and kind of what that looks like and how you possibly are doing that. And then obviously Peak Multifamily, kind of what your role is there. But let's start with the realtor business. So you're a realtor, you're based out of, was it Burlington? I can't actually remember.
I was local, but I'm in Mississauga now.
Yeah. Okay, you're Mississauga. Okay, and you've got primarily investor-oriented clients. So how does that work? Because very few investors can make the numbers in the GTA work. What areas are you servicing? How are you doing that? Or is it ultimately just like a certain type of clientele that you have that can make the GTA work?
Yeah, so I started off the business a little bit unorthodox in the sense where what I was doing is I was looking for deals and underwriting them myself, and then basically would put it out there like, hey, I have this deal, it's hit this criteria, and I would shop it to investors that I know. And then they started buying them, and then they started buying them. And then the addressable market that I was hoping to serve was kind of like the Mississauga to Hamilton market, but it's branched out, a bunch further as deals kind of come across and we get listings in different places. So it's an interesting business because, as most people know in real estate, everything's word of mouth, reputation, and stuff like that. So if you provide good service with someone and, they have a good experience with you, and most importantly, you make the money, they're going to reference you and you're going to get more deals and stuff like that from it. So that business in, I think, 4 or 5 months has, grown from basically zero to what it is now. And next year, we're hoping to have like a 7-figure year from what's called GCI, gross commission income.
Mm-hmm. So let's talk about that a little bit more. Obviously, with continuing off of you said, with the industry being sort of at a standstill, it seems like obviously people have a lot of confidence when you run your numbers, you show them the deal analysis, so on and so forth. When you were first sort of getting started, were you getting clients immediately, or did you have to do any marketing whatsoever? Like, how does that look like? Because people who are looking to enter the industry now, I think the biggest fear for them is getting leads, especially with sort of the condition of everything.
Yeah, I think people take a bit of the wrong approach on the realtor side, right? Like, most people decide to get their license and then decide to build their brand and reputation and things like that. And it's really hard to get started from nothing, right? So I took a bit of an unorthodox approach where I started on the investment side, met a bunch of people, like made a real big effort to network and kind of get my name out there and build reputation. And then once I got my license, I had already kind of bought myself some credibility and contacts. And also from doing my own deals, I had a bit of an advantage on kind of knowing how the paperwork worked and doing off-market stuff. So I guess my advice for anybody, if they're starting out in something like that, is position yourself with someone that's already doing it. And don't be afraid to do kind of some of the crappier work at first, right? Like, a lot of realtors hate doing leases. So if you come in and you go to a big realtor and they probably have $100,000 of leasing work a year that they don't want to do, you can walk into a 6-figure business and just take that on, and you're going to learn the business really quick. And once you build trust with that person, they're going to start throwing you bones here and there, and you might get a listing, you might get some buyer clients or whatever. So I don't think there's any specific way to become successful in it. Not everybody does it the same. However, I think that you're disadvantaged if you try to do it like everybody else and just try to start from scratch without trying to align yourself with anybody.
Yeah, it sounds like you're finding the deal first, because most realtors, they come out here and then they go, okay, I need to find like a buyer that wants to like buy a property, and then once you find that buyer, you're going to go out and you're going to look at whatever properties they're interested in. Sounds like you're going a little bit the opposite way, and you're going, let me find a deal first in whatever market this is. I'll market the strength of the deal, and then there will be a buyer. Is that kind of what you're going with?
Yeah, it's become a bit of both now, but that's what I originally started with, right? Like, when I started as a realtor, there was no guarantee that I was going to have success. So I was also A/B testing with different strategies and stuff. But I thought about, how do I offer something that's more unique than other brokers and realtors? And the realization that I came to was that a skill set that I can kind of see some diamonds in the rough and be able to bring those other people where maybe they might not see them. And through that, we built a lot of great relationships, and we've moved a lot of properties in a short period of time.
Awesome. Do we want to dive into the multifamily stuff, Maya, or did you want to round some stuff off?
No, let's go into multifamily. We'll come back into limited partner side. So I think that's pretty cool as well. So the realtor business is there. And then obviously you've got a lot of stuff that you do with peak multifamily. I'm not 100% sure what your role is there, but like, how does that work, and how did you get into that, and what's your role and so on there?
Yeah. So just like how I was saying with, how you start on the realtor side for someone who's maybe starting new, to align yourself with someone who's doing where you want to be. So I always knew Mike Rockall, who was one of the founders of Peak, from the broker side, and knew that he was pretty heavy influence in actually selling apartment buildings and stuff. So I knew that that's where I wanted to be eventually on the broker side, as opposed to maybe focusing on smaller stuff. So I approached Mike, and we ended up kind of forming like a partnership, and Mike ended up making a team. And I ended up joining his team at Keller Williams. And then basically, because he's so busy with his fund, getting everything up and running, I've been helping a lot on the broker side and taking on a lot of that kind of deal flow and stuff like that, so that him and Mark can focus on the fund. So just natural progression of me kind of working with them over the last little while, ended up doing some fundraising stuff and kind of helping them on the fund side, as well as me being an investor in the fund myself. So I'm a big believer in, if you're gonna work on something or, contribute towards it, you should put your money where your mouth is and also be an investor too.
I mean, being an investor yourself in the fund and raising capital, what are some of the things that you look for on the multifamily side when deciding when to invest into it? Because there's a lot of opportunities out there, but there are probably some criteria that you're looking for that makes a good multifamily investment.
To be honest, there was a lot of things I didn't know that I learned very quickly, right? I, about a year to a year and a half ago, was putting offers on 20, 25 unit buildings, and I thought I had the proper skill set aligned there. Thank God those offers didn't go through or didn't get accepted, because once I started working with Mike and Mark, I realized that, there was probably a 30, 40% skill gap that I was missing to do some of these deals. I think a lot of people, what they don't realize now is what their true cost of bridge financing is and their true carrying costs. And, I think people don't really realize when they're sizing up from residential to multifamily of the capital requirements that are there and how capital intensive it actually is. And it's funny now, being on the broker side, I understand when I get an offer from someone that's sizing up from residential, or I get an offer from someone that's seasoned in multifamily, the way they write the offers are completely different and the things they care about are completely different. So it just shows you that even though it's a very similar business, it's also very different in the same sense. And in residential, you can hurt yourself financially, but it's somewhat hard to financially destroy yourself. In the large multifamily space, you can make one wrong move and you can financially destroy yourself. So proceeding with caution is much more apparent.
Mm-hmm. So you brought up a pretty good point, the difference between residential and multi from a realtor perspective in drafting up condition and paperwork. Can we talk about how that transition has been? What common sort of conditions you're putting in the multi that you don't traditionally see in the residential, and other considerations? It looks like Maya wants to jump in and say something.
No, I think you meant more like investors, right? Are you saying on the realtor side, or are you saying there's a significant difference between investors leveling up and investors that were already multifamily guys?
I think it's a combination of both. When you see how someone from the residential side, maybe someone that's had 5, 10 properties, sold off their portfolio and they're sizing up, compared to maybe some of our other clients that have 5,000, 6,000 units, the way that they write offers and the way that they underwrite deals, I find is very different. And, most of the people who are sizing up on properties are looking for these really distressed kind of value add properties that are, so-called BRRRR properties, right? But BRRRing doesn't work as well and doesn't scale up as well to multifamily as people think. These buildings are really made for long-term capital preservation, and it just doesn't scale the same way it does from the residential side. And I think people have false expectations where they think they can flip these buildings in, 6 months, 8 months, 9 months. And the reality is they're just not meant to do that.
Really? So do you think the multifamily space is then meant more so for the funds and syndicators and like the three of us pooling like whatever we consider as spare change or investable capital and leaving it aside and kind of injecting there? Do you think that's a model, or because people were doing BRRRRs a couple of years ago, no? 2020, 2019, 2021 maybe, but.
Yeah, I think with low interest rates, a lot of things were possible, right? It drove a lot of different strategies that probably weren't good long-term strategies. No, I think it's for everybody. I just think that the expectation of how long your capital should be in a deal, longer term investors, guys that I work with that have huge portfolios, none of them think the same way of recycling capital at the same speed that maybe guys sizing up from residential do.
Yeah.
So the way they look at deals of saying, hey, you know what, this is actually a good deal because my money's stuck in it for 18, 24 months. I want this deal still. Whereas if I go to someone on the residential side, they're like, no, that's way too long for me to leave my money in. But they're looking at it different. They're looking at the long-term CapEx, the long-term tenant profile, other things, right? They're looking at more the macro, the 5, 10 year, whereas I find a lot of residential guys are looking at the 2 to 4 to 5.
Yeah, I mean, to be honest with you, really how real estate should be invested is looking at the long term. I think we've just been spoiled with the capital appreciation that we're used to like pulling our money out quickly, but that shouldn't be the benchmark even for residential in my honest opinion, right? So I kind of want to scale things back again. So you were mentioning the differences between people like the bigger guys, not only underwriting. So by underwriting, I assume you mean not only are they more conservative, but they're okay with capital being tied in longer, but conditions wise when dropping in offers. Can we talk about the differences on the conditional point of view and the documentation that's needed on the multi versus the residential? Because I think that's very important for someone who wants to scale up. It's not only about like just scaling up, it's about knowing what to add in your contracts.
Yeah, for sure. I think a lot of it comes down to a lot of the due diligence clauses. So making sure all that stuff is in there, like, you know, stuff on your phase one, if you have to go phase two, things like that. Also making room in your conditions for contingencies and delays. So a big thing in multifamily is, you know, delaying a property or delaying a closing or this, that, whatever. You know, typically there's large fees associated with that. So a lot of times we want to be able to cap those fees, because the reality is with CMHC or with bridge financing, there's a lot of things that slow these deals down and they don't happen very quickly. I would say also, you know, being able to write an offer in a way that protects your client, but isn't something with 8 or 9 pages. So a lot of times, you know, you'd be very surprised. I work with these guys at multi-billion-dollar funds, and they'll come in with conditions on a $5, $6, $7 million building. And it's 1 page of conditions, but it's so properly written on how it protects their client that it portrays confidence to the buyer, the seller on the other end. Whereas I see people on the residential side or agents who aren't used to it, where they come and there's 6, 7, 8 pages of conditions. And what that says to the seller on the other side is basically this person's probably not serious, or they've never done a transaction like this before. And multifamily is weird, right? It's not always about price. A lot of times, you know, people want to sell just knowing that you can close. And a lot of these people have really deep pockets. And sometimes if you just offend them by the way you write your offer or how you present it, they just won't sell the building to you because they don't need the money.
Listen, that's real fuck you money there.
Yeah. So what is the solution? Because like, how do you level up? Because I don't think anyone wants to stay in like single family, duplex, triplex, like fourplexes for too long. I think you can relatively easily get into like under a 10 unit building, which is like where me and Austin have both been playing, right? Without like too much difficulty. But once you get like above 10 units as like a general like rule of thumb, the price points get up there. And so then we either have to be able to tie in a lot of money, or you got to syndicate and raise funds. But is there any other solution? Like, how do you get into like a 15 to 30 unit building if you've been doing like 5 to 10s all this time?
So VTBs are, and seller financing is like the hot thing in multifamily right now. Because of where interest rates are, almost every single building that we're seeing that's either on market or off market has some sort of seller financing. And we're seeing, you know, on many, many deals, first position private mortgages from the seller for 80 to 90% LTV with pretty attractive interest rates.
Yeah.
So a lot of these guys, you know, our girls or funds or whoever has the properties, a lot of them are paid off and they're okay to do that to defer taxes and stuff. But I would say the majority of our clients that are transacting right now are getting some sort of VTB in every single way. And for those that don't know what a vendor take back is, you know, basically it's when you get seller financing or whoever's selling the property decides to give you some sort of loan proportionate to the value of the sale price. On the residential side, people have been talking about it for years, but banks have really shied away from allowing it. It's very difficult. And in my, you know, experience, and Mike, you can talk to this, it causes more problems than it, you know, it helps. But on the large multifamily stuff, it's very easy to use. And most banks are willing to work with it.
Yeah, or the residential side, you got to get creative versus like on the commercial side, you can be upfront about it and transparent, and it still can actually work like legitimately. So that makes sense. So are you seeing then that the prices that people are asking are a little bit like overpriced, and that's where they're coming from with the VTB? And then the second question is there not a risk on larger multifamily? Like the VTB has to be repaid at some point, right? So like, what do you see as like the solution? Are these properties where people are like banking a certain amount on lift, on a certain amount of like tenant turnover? Like what are you kind of seeing there?
Yeah. So most of the sellers that are offering the really strong VTBs have the exit already kind of lined up with the seller. So most of the time there's some sort of lift on tenant, or there's some sort of way that within that time period, the money's going to come back and be able to be repaid back. And I would say 99% of people's strategy is going through CMHC to refinance the money out at some point. And if you can't stabilize a building in 5 years of ownership, which is the typical term for a VTB that we're seeing right now, you've probably got bigger issues to fry. Now, the other thing too is, going back to your question, you're asking, if I ask for a VTB, does that mean I pay a premium on price? The answer is no. People are getting great prices with seller financing right now, and that's just what the market's dictating.
I just wanted to, again, take a step back and overall thoughts on the market with commercial, residential, being involved. It seems like you're still doing a decent amount of volume here. What trends are you noticing overall from investors, home buyers, both on the residential and the multi side?
So investors that have positioned themselves to be long-term investors and look long-term scale, I'd say are doubling down. And the people that were kind of dipping their toes in the water before and were maybe in real estate because it was sexy at the time, those people are really shying away from it. Real estate is not sexy right now, but for people who are long-term investors, they're picking up fantastic deals all over the place. But I would say overall, deal flow is down, right? So maybe someone on the multi side who maybe buys 2 or 3 buildings a year is only buying one now. And for someone on the residential side who maybe pulls off 2 or 3 transactions, maybe pulling off one now. So I would say everybody, no matter what, is slowing down unless you have some, weird influx of capital.
Understood. And on your side of investing, so we chatted about your different active income streams, how you're involved in different businesses. Are you still personally picking up real estate yourself, or have you taken more of a passive approach and started like investing in the fund more so than doing stuff yourself?
Yeah, so a bit of both. And I always share with my students, like, there's nothing wrong with being a passive investor too, right? You get busy, if there's a good opportunity that comes along that you can have a piece of and you have capital to deploy and the deal makes sense, like I'm a big proponent of that. But still actively buying. I would say, all the active income streams that I work on, my main business is still being a full-time real estate investor. I closed on a property in Barrie about a month and a half ago. I got another one closing there in the next 90 days. And then a house that I've patiently been waiting on in Blue Mountain for the past couple of years. That was pre-con. I should finally be done at some point in June. So still adding 2 or 3 kind of properties in the next 12 months.
So what are you looking for on your personal investing side? Because I know with the fund, that's how you put your skin in the game on the multifamily side of things. But from your personal residential investing, what criteria in this current market make sense to you?
So I'm buying less, I don't want to say less distress because I do like distress, but less heavy renovation projects. So what I'm finding is at good prices, I can find decent assets in decent areas that don't need crazy extensive rentals that I used to do and used to cause tons of headache. But what I started doing was I started kind of joint venturing with people and doing different deal structures. And I kind of figured out like a little loophole or hack that I've done twice now in the past couple months. So I basically align myself up with someone who's going to be a first-time home buyer. They might not be able to afford a down payment on a property, but they can qualify for maybe a $500,000 or $600,000 house with CMHC. I partner with them as the money partner, take 50%, typically retain most control on the asset. They qualify for the financing. And then I find the deal, I buy it and put up all the cash. But because of my realtor fee and commission is paying for about 30% of the down payment that I'm getting into the deal for. And because they're only putting 5 or 6% down, I'm getting in multiple projects now for only $30,000, $40,000, $50,000 of my own capital. They're super happy because they would never be able to get a down payment together to get into an asset. I'm super happy because I own 50% of the asset and have that asset paying a portion of my down payment down. And the model's been working really well. And I think it's a scalable model so far.
Yeah, that's it's funny you mentioned that. That actually early on in my journey, when I bought my pre-construction, the one that I'm living in right now, same sort of situation where the realtor's like, look, like if you are having cold feet, I'll put in some of the money with you. I was like, how? Like, where is he getting all this? It's like, oh, yes, the commission. So you're basically reinvesting the money that you earn, right? And it also shows good faith as well. Because there's not many realtors who's going to, yes, they'll sell your property, but there's not many that'll actually put skin in the game and actually give you money, right? That is saying a lot.
I think the key is Jack has other like sources of income as well, right? Like
that as well.
Realtors also have like multiple investment properties in different businesses and stuff like that and have the ability to do that. So I think that's pretty cool. I think also on that topic, I just want to quickly talk about.
Wait, sorry. Are they living in the property? I assume, right?
Some of them, most of them are multis, right? So we're trying to get like duplex.
Okay.
So
Gotcha.
they could be owner occupied properties. And then we have special, basically, income splitting arrangements on it. But, I'm a big believer in negotiation. Like everybody should kind of win. It should be favorable on both sides, right? So I'm super happy with my arrangement. They're super happy with their arrangement. It gets me more properties with higher leverage, right?
Yeah. No, that's great.
I personally think it's pretty freaking smart idea, but to each their own and their own strategies, right? So going on from there, so I obviously, I just want to quickly touch on one thing you said earlier. Yeah, I think the passive investing side is a great model for a lot of people. If you're essentially busy, have a high income like business or like something like that, I think being a passive partner is definitely the way to go. It's a super easy life to and a way to like build a decent sized portfolio with like limited effort, right? So from there, if we talk about the limited partner business, because that's the second thing that I kind of want, or third thing that I want to quickly touch on. So you've got the realtor side, you've got your income side coming in, and now you're investing in all these different businesses. How do you go about finding these businesses here that you can invest in? How do you go finding good partners that you can invest with? Just kind of explain to me how that entire like business side has come about.
Yeah, so it's a bit unorthodox. I would say I don't advertise it and I don't really look for it. Just by putting myself out there and people knowing that, I enjoy doing different investments like that. People approach me with a lot of different opportunities. I would say I turn down probably 2 out of 3, but, 1 out of every 3 of those has some sort of long-term potential. And I'm an entrepreneur at heart, so I like investing in other businesses too. However, I try not to shy too far away from real estate as kind of my main investment strategy. But, there's a lot of really good businesses out there. And I think diversifying at some point is a really good strategy to do. And, a lot of people that didn't do that and got caught with their pants down in the real estate market, I think everybody learned a hard lesson that it's nice to have income streams that are not tied to real estate.
It's true, but I guess how do you go about evaluating different opportunities? Like if someone comes to you with a restaurant, like, I don't know, like maybe this is good, maybe it's not. Like, what do I really know about restaurants and like profit margins and stuff like that? Because I'm very similar to you. Like, I agree. Like I was trying to diversify into like completely like unrelated businesses. Like I looked at laundromats, talked to some guys buying some, and it was just going to be like a silent partner in some of their stuff. I was like, like I don't really know anything about this business. And if this partner decides to fuck all and like just go, fuck it, I'm out, right? Then I'm kind of screwed, stuck trying to run this business that I want nothing to do with. So how do you go about evaluating a business? What do you look for? What's the criteria?
Yeah, so most of the investments that I've done on that side have pretty much all been distressed in some way. So I'm coming in with some sort of favorable term that allows me to dictate terms towards, what I like. A preferred strategy of mine is using something called convertible debt. So, when a business goes bankrupt and fails, the shareholders in that business typically get wiped out and no one gets any money back. But people who sit subordinate on the debt table typically get paid out depending on what assets and what loans and stuff like that are left. So how I usually structure my ownership is basically that it's a loan to the business that I get to convert to equity if I please at a certain value and strike price. So kind of like an option on the business that doesn't expire. So what that does is it allows me to ride my loan out with the business. And if I start to see that the business is going to succeed, it's being operated well and all those kind of things, I'll convert my loan into equity. And then I share in the ups and downs of the business equally with that owner. But if the business doesn't get off the ground or get past the distress part that typically why I'm coming into, at least I have a personally guaranteed loan by whoever's running that business that's also backed by the business's assets. So there's a bit more collateral for me to kind of chase, and that it also creates more passive income in the interim until I do convert to equity.
Are these businesses typically heavily levered? Because for that to work, I assume that your debt, you're saying it's backed by the business's asset, it needs to have a decent amount of unlevered assets there.
Yeah, not necessarily. Like, some of the businesses like laundromats, like a livestock business, a bar and restaurant, stuff like that, where people either need capital for scaling, they need capital for accounts receivable. So they have orders and they can't fulfill, inventory or whatever. Or maybe they've put their life savings into a project and they're like 10% to getting it across the line. But with that, the business will fail and that 10% will get them over the line. So those are the kind of businesses I like helping on, because not only helping people, but it springboards the venture into kind of its next chapter, right? And typically that drives further revenue growth.
So what's your role in the business after? Because you put in the capital. And so I'm making a couple of these investments myself. So I'm trying to figure out what is the right balance, right? It's like, I don't really want to be like here on a day-to-day basis, right? Nor do I intend to. But how do you drive value beyond the capital?
So I take a pretty heavy advisory position until that business is stabilized. So like we'll do touch points maybe once or twice a week. Never ever do I invest in anything where I'm boots on the ground, because my other businesses don't allow for me to have time for that. But mostly advisory, points. And a lot of the times when I do these investments too, I bring a bunch of friends in that have different skill sets and stuff like that I grew up with, and we all kind of contribute in different ways, right? So doing business with friends is hard, but doing business with friends in the right way and in the right capacity can be very beneficial, as long as, people understand different boundaries and things like that.
Interesting. So what's like a normal composition? Because like if you're trying to put together a team of guys, like what does everyone contribute? What do you contribute, like from like an advisory perspective? What's like your role from the advisor side? Are you advising on like financing? Is it like growth? Is it marketing? Like what do you normally like opine on there?
Sure. So I'll give you an example of a bar in Toronto that a couple of friends and I did. They were 90% to opening. They put their life savings into it, and they just need a bit of money to get past the line. But what was also holding them up was finishing construction permits and construction delays on the property. So I thought, okay, well, my experience on the real estate side with construction, permitting and stuff like that, I have contacts. I can help get this across the line quicker, get us opening faster. I trust their ability from their, previous experience and operating, in that industry. And the numbers make sense from this perspective to me to take that capital risk. So I would say it really is determined per the deal. And, it's not as structured as you say. I wouldn't have like, I call this friend for that skill set or this friend for that. It's just more of a group of us. Whoever has extra capital together, we'll look at different opportunities, and every way we can try to help to grow that business, we'll do it, because when we invest with someone, we invest with them as owners, and we'd like to think we're part owners of the business, whether or not we've converted into equity or not.
It's like a real life Shark Tank. I applaud you for investing outside of just real estate. To your point, I think a lot of us, it's a good thing that we're iron focused in what we enjoy and what we're good at, but it's also important to diversify your investments outside of just one asset class. Now let's pull things back in the real estate topic. We chatted a bit offline before we started recording. But what is it that sort of keeps you up at night? Like, what are some problems, some issues that you run across in your real estate business? And I ask this because I think everyone tends to see, like when they listen to this podcast, they tend to imagine everyone's extremely successful and there's no problems that go on at all. And we know that's far from the truth. We're chatting offline about like a tenant issue that you're having. So what are some growing pains that you have with managing multiple businesses, or maybe just on the investing side?
Yeah, 100%. So like, just as everybody else does, I have my own challenges and not every day's easy. And I kind of came to a point where it was about 6 or 7 months ago. And I called my best friend over, who, is always a good person to look at my business and my whole life from like a 5,000 foot overview. And I just said to him, I'm like, you know what? Like, I don't know how to grow these businesses anymore. I'm working every single day of the week because a realtor business demands nights and weekends, and my coaching business and everything else is, 9 to 5. So I said, I just don't know how to grow. I don't have enough time, and like I'm losing sleep, and it's like starting to affect relationships and, just everything, right? Like your mental health and all that kind of stuff, and your physical health. So we went through all my businesses and we looked at everything, and he came to the conclusion. He's like, the only thing I can think of is you just need to hire. And sometimes you got to bring someone outside just to help solve these problems, because it never, ever, come into my mind that, yeah, maybe I need an assistant or need someone that can offload some of this. And it took me a month or two to wrap my head around like, oh, do I want to incur an expense like this? Like, is it actually going to help? Will it make a difference? And then my family, my grandmother just said, like, what do you have to lose from trying it? Worst case, if it doesn't work out after 4 or 5, 6 months, and it just doesn't work out. So I hired a full-time assistant that's half in my personal life and half in my business. And since then, we've been able to almost triple the revenue of the business in 6 months. I think at every stage of you growing your business, there's pains and there's problems. And I think part of the fun thing about being an entrepreneur owning a business is creating hard challenges for yourself and overcoming them.
Couldn't have said it better myself.
Yeah, no, that was really good advice, man. I think, no, I think a lot of people need to hear it. Everyone's got a different challenge at a different point. And there's ups and downs in any business, right? So Jack, I guess on that topic, at this point in the podcast, we ask our guests 2 questions. The first question is, where do you see your business growing in the next, call it like 2 to 3 years? Like, what's the focus? How are things going to change? Like, what's it going to look like?
Yeah, so I think 2 sides. On the active income side, I think moving more so into the apartment building sales, so bringing more really good deals and helping investors size up from residential into apartments. And, a lot of friends that are kind of actively looking to either do that or start doing that. And then I think on the personal side for me is just acquiring more assets and actually acquiring more larger multifamily for myself.
That's very dope. All right. And then for newer investors, I think you might have already answered this a couple of times, but for newer investors in today's market, what piece of advice do you have to share with them? Maybe someone that's looking to get started, jump into the market.
Yeah, at any level you're at, don't be afraid to just offer someone who's in a position where you want to be in a year or two and just offer your time for free. I was a 5 or 6, 7 year investor by the time I approached Mike Rockwell and just said, hey, I want to offer you 1 day for free a week to learn how to sell large multifamily. And because I did that, it gave me exposure to a whole different set of business. So in summary, I would just say, don't feel afraid to reach out to people ahead of you. A lot of people appreciate it, like the recognition of people recognizing where they're at. And most people in real estate are extremely friendly and willing to give people a helping hand.
Listen. No, totally agree. That's how I sort of kickstarted my journey as well. I was mentoring under Mike Rosart. So every weekend I'd go there and just help him with stuff and I would just learn along the way. But I don't want people to get it twisted. You don't go there and just ask for like free coaching or mentorship. You have to exchange a lot more value to receive value back. But great podcast, Jack. You're always up to some amazing things. I'm sure when we have you on in the next year or two, you're going to have a bunch more things to talk about, many more businesses that you'll expand into. For anyone who wants to keep in touch with you, follow your journey, how could they best do so?
Yeah, you can follow me on Instagram at Burnstone Capital or my website, www.burnstonecapital.com. Happy to take a call with anybody.
Awesome. That will be down in the show notes below. And if you guys enjoyed this episode, which I know you definitely did, so make sure to leave us a 5-star review, share it, comment, do whatever you can to support it because it helps bring great guests like Jack on. And until next time, everyone, invest smarter and live better. Take care all.